What's happening, investors? Let me introduce you to your new company in your portfolio. It's called Equinor. You guys like dividends? How about a 10% dividend yield? Look at the sweet, sweet Equinor website over here. We don't just energize people's lives, they say. We want to empower them too. How about you empower your own account with a 10% divvy? And that's after taxes, by the way. Not only that, but you might even get a tax credit at the end of the year, especially if you live in the US, you get a little 10% tax credit. But check this out, okay? I have a super professional, okay, short little research document here that I've put together. Now, this PDF, I'm going to try to make more detailed ones in the future. I put them up on the website. Yes, I have a website under development. Can you believe this? For just my own research. It's going to be called Dark Horse Research, I believe, unless I decide to change the name. So far, I have this. And I'm going to be putting these documents up. I'm going to run off of this for today and see if I can give you some of my thoughts on the company and why I think company is definitely a buy right now. All right. Now let's first talk about the dividend, because that's kind of front and center. The 10% dividend, they give out a 70 cents dividend 4 times per year at the moment. Obviously, that's subject to change. Oil companies are notoriously cyclical, so it will go up and down with the years. But over the long run, I believe, and historically, it's proven that the company is a survivor. So it will keep paying dividends, even if it's less than that for a couple of years here and there. 70 cents per quarter. That's 35 ordinary dividend cents, 30 ordinary dividend, and 35 cents extraordinary dividend. It's split into two for 2 different categories. One of them can kind of be looked at as a capital return, if you will. Out of that 70 cents, if you live outside of Norway, you're going to be, or it depends on the jurisdiction actually, but in the US, you get taxed 25% foreign tax. But actually, at the end of the year, you get 10% of that back. You can file a form and keep it on file with your broker to not get that money subtracted right away in case you want to reinvest it throughout the year. Now, this is not a tax advice channel here. I just want to talk about the company, but it's part of talking about the company that you can manipulate taxes a little bit that way. Now, excluding that 10% foreign dividend tax return that you might get at the end of the year, we're sitting at 51 cents per quarter for a $23 company per share. That puts us at a little bit over $2, $2.4, something like that, $2.04, which is almost 10% dividend. Before, that's after tax. That's the craziness, okay? Let's take a look at some highlights. Equinor, it's $63 billion company. The dividend yields a little bit over 10%. It's 23.24 price per share at the moment. Now, what is my investment thesis here? I think that, personally, that the global trend is shifting towards more politically, like oil-friendly policy making. Ever since the election of the American president, things have started to shift around the world. We have, Malay and Argentina. We have, a lot of change in the political landscape across the globe. And so I think all the policies moving forward will be very oil friendly, because the countries are going to turn a little bit more nationalistic. They're going to compete for their own personal interests. And a big part of personal interest is energy production. It's oil. So just from a policy perspective, I think this is a winner. Right now, they're very pro-renewable energy type of company, but recently there's been a publication where they've said they're going to shift their focus more into their core cash flowing generating business, which is oil natural gas, etc. So that's a good shift if you're an investor in the company. And at its current valuation, I personally have grabbed lots of shares. Now, for me, I'm not that rich, right? But I owned around 6,000 shares. And I'm receiving a juicy dividend here on the 28th of February. Hopefully, the company doesn't tank from here, but that's the situation. Let's take a look at some figures. I really like, as you may know if you've seen some of my other videos, that I like to browse through stockanalysis.com. Here's a 5-year chart of the company. It's reached a high of 41.55. It might be even higher, but the chart's not showing it. So it can get over $40 if the conditions are right. The valuation's been up there. You can get there again, guys, especially with this shift. They have a ton of cash. This is part of the investment thesis from the document here. They have a ton of cash, okay? So what they can do with that cash is they can get cash producing assets. They can get cash flowing assets. They have 24 billion of cash, 30 billion of debt at the moment. They can go on a shopping spree and turn the company into just a cash spitting machine, which it already is, but more so. But they're even generating, they're even acquiring more cash because they're selling some of their non-core assets, some assets they're not really using at the moment, and so maybe they're saving up for some big purchases. One thing's for sure though, with that much cash, the dividend is safe. Not only is the cash a backstop for that at the moment, but it's kind of a quasi-state company. This, you can think of this company as basically Norway. It's a country, all right? The country owns it. It owns a huge part of it and also collects like 70+% of taxes from the company, which drags it down understandably, but there's such a huge cash generating machine and the tax is already factored into the price. So let's take a look at some numbers, shall we? I like to look at quarterly, as everyone knows. Okay, operating revenue. How about revenue? Revenue peaked out in 2022 when it was at the $40 mark per share. Now it's hovering around 25. It's climbing steadily though in the last few quarters. That's fine. Cost of revenue has been also climbing just as much as the revenue has. Although there's been a tiny bit of divergence in the latest quarter, revenue has been climbing faster than the cost of revenue. So that's a good sign. On another positive note, look at the decrease in admin costs. These are not insignificant. We're going from 350 to 260. That's $100 million less per quarter while the revenue is increasing. Operational income up. Okay, we're sitting at $8 billion operational income for this previous quarter. That's a lot. Just saying. It has peaked out at $24 billion operational income. Obviously, not all of that is getting passed through the investors. Lots of it is being grabbed by the government. You'll see in a minute. Interest expense is pretty steady, actually. They're levered up a little bit. It's a very safe leverage ratio. I don't think I'll ever worry about that. Interest and investment income. How about we do some net income to common? We're talking about net $2 billion for the latest quarter. It's probably going to be around this for a long time unless we see some kind of significant change. $2 billion net per quarter, 8 billion per year. Shares outstanding. They've been buying back shares, guys, ever since forever, right? Look at, even through 2020, they've been buying back shares. This share count is steadily going down, which means that every share you own represents a greater proportion of the company. Now, it's a little bit important to stop for a second and really let that sink in for a moment and understand what it really means, okay? Now, it actually kind of net neutral, because even though you own a greater part of the company, when they buy back shares, your share is worth more, like in relative, relative to the company as a whole, right? So like, if you have 4 shares, they buy back 1 share, you have only 3 shares, so you used to own 1/4 of the company, now you own 1/3. But the problem with that, not problem, but the side effect is that you own 1/3 of a smaller company, right? So by them retiring the share, they're giving money out of the company to someone who just sold a share to them, right? So let's say they buy that 1/4 of the company for, $20 billion. Okay, so yes, you own 1/3 of the company now instead of 1/4, but the company is missing $20 billion. You see how that works? So it's kind of net neutral. It just depends at what time the company is repurchasing shares. There is this positive side effect though. By buying back shares, a company is reducing the liability it has to its shareholders, especially if the company is paying large dividends. Okay, so basically you can look at it from this perspective. When a company that's paying dividends is buying back shares, you can think of it like they're buying a company, not necessarily theirs, that's giving them 10% dividend per year. Do you see what I mean? It's kind of like they're buying a bond that's giving them 10% per year. That's where they're investing their cash. So it's a really good purchase, especially if the company is giving out big dividends. And if they're still churning out the same type of cash, it gives them room to do what? Raise the dividend in the future. Isn't that crazy? How cool is that? Right? Let's move on. Dividend per share. They're trying to increase. I think this is wrong. I think from next quarter they're going to increase it to 37 from 35. They do 2 parts, 35, so 70. Now they're going to do increase to 37, so we'll see how that goes. Margins are insane, okay? I think this is one of the highest margin business oil producers out there. The thing that's kind of dragging him down, right, is of course, and the reason why the valuation is like this is this number here. 75, 68, 75.58 in the latest quarter. That's tax, guys. That's tax. But don't dwell on it too much. It's priced in. The company, if it was not taxed that much, it would not be sitting at a valuation of $63 billion. It would not be doing that. The enterprise value is 69.92, reflecting about an $8 billion net debt position. The short interest is extremely low. Nobody would dare short this company. Here's a quick breakdown of the income statement at a glance. Got a revenue of 102.5 billion, gross profit 42, operational income 30, pre-tax income 38, net income 8.8, earnings per share $3.11. The balance sheet. Cash and cash equivalents. This is what I was talking about. They have $24 billion to go on a shopping spree. They can buy some Gucci, they can buy some Fendi, or they can just buy some cash flowing assets. We'll see what they do with that. Debt is nice and healthy. We don't need to even touch that. You can operate on a leveraged basis, especially if you secure good debt, APR, right? Rate, good rate on your debt. And of course they do. They're a big oil company. They're basically a country. So of course they're going to get good rates. The EV to earnings. Actually, let's look at the PE to earnings. PE ratio of 7.17. And that's not, the E side of this equation is not going down. Okay. So either the price stays the same or it's going to go up. There isn't much downside to this company, which is why I really like it at the moment. What I want to say about the PE, right? There's not a lot of downside of the company, and the reason this is the reason why I think it offers a very strong, it's a very strong candidate for covered option strategies, which is exactly what I'm doing. I'm doing covered calls, covered puts, basically selling puts, selling calls against the company. Now there is a little bit of a kink, if you will, for this company when you're selling covered calls and puts, is the price of the option will get reduced periodically because of the capital distribution portion of the way the stock works. But I don't think you should worry about that too much. If you're selling calls a little bit over the price, the strike, I think you should be fine. Maybe $1 more or something like that, or 2 or 3, whatever you can get enough money for and you think it's worth doing. And same thing for the puts. I don't think you should worry about that kink too much, personally. And guys, make sure you trade this in an individual account so you can take advantage of the foreign tax credit. There's so many other companies you can be putting in your Roth and your IRAs, okay? If you want to do, you can put REITs, a really good investment for your Roths, right? Or you can do like, for individual accounts, you can do qualified dividend American stocks, okay? That would be good. And for your IRA, I mean, I don't know, that doesn't really matter. You can do anything in there. But I'm not a tax consultant, okay? I'm not a tax advisor, not a tax consultant. Everybody should obviously do your own due diligence. Look at this nice disclaimer I've written here at the end. All right, hold on. This report is for informational purposes only and does not constitute financial advice. Investors should conduct their own due diligence, consider their personal financial circumstances, and take, most importantly, responsibility for their own investment decisions. I don't want anybody in the comments crying that, hey, I bought Equinor and it dropped like 5-10%. It's your fault. No. It's your fault. Okay? It's your fault for listening to a YouTuber. You should do your own investment research and decision. And if you're confused, contact a professional. Okay? So, anyways, let's see if there's anything else that I can add here for you guys. Oh, look at this. So because of this high price that it traded in 2022, we know the potential of this company. So there is a potential for 100% upside in the price in 3 to 5 years. I'm not going to probably wait around to see that. I'm going to be selling covered calls, and so I will possibly never get that upside, but it is there. So if you want to just leave it in your individual account, collect dividends, and wait for that upside, it could happen. Now, of course, there are risks. Okay, there are risks. You can have an oil downturn, you can have low persistent prices, you can have changing governance and political landscape, you can have very, draconian, like hawkish government policies. They could neuter this company. They could ban it from European countries out of the Norway. You can have a bunch of negative stuff happen to the company. You can have natural disasters, operational accidents, and these are the risks that I think are most pertinent for the company. But there's also positive catalysts. The oil price could increase. We could have a boom. What if the economy just spurs around the globe and everybody wants more oil, more energy? It could happen. Look at the AI, right? What do you guys think AI runs on? Right? All these graphics cards, they don't run on thin air. They're not running on wind and solar. Some of them are. You need energy for that. Everybody loves the AI tools. You think ChatGPT is going to disappear? We need server farms. We need graphics cards. We need NVIDIA farms, right? That thing takes a lot of energy. Okay. Not to mention the Bitcoin word. I don't want to mention it. Okay. So you got all kinds of stuff demanding energy. Plus, the global population is still rising. I know it's in a kind of a downtrend when it comes to the new kids coming out, replacement rates coming down. So the population of the earth is going to cap out at some point. It's going to plateau, but it's still rising. There's still new lives coming into existence, and the living standards of the world are increasing, and so there's going to be more and more energy demand. Given all that, given all this information I've presented, I can't help myself but own this thing. Okay, I think it's like the next best thing since sliced bread. I'm gonna milk this, I'm gonna sell calls, and I'm gonna collect dividends as long as I can. If I get hit on one of my calls, meaning I'm forced to sell my position because I've sold calls against it, I will probably look to sell puts on it. If the price runs up too high, I'm gonna say, okay, I've missed the train, that's fine. I'm gonna collect the dividends and profits that I have so far, and premium, and I'm gonna move on. I have plenty of other ideas, that's fine. But this is where I am right now, okay? Again, if you want to download, if you want to get the PDF, I can share it for free at some point in the future. I'm working on my website right now. I will make more detailed ones so you can kind of browse through it on your phone and look at PDFs or whatever you want to look at in the future. But for right now, it's in the works, construction site. All right, let me know what you think about the company. Do you own it, first of all, and what you think about it right now, and why am I wrong? Okay, I want to know why I'm wrong about all this. This is the main reason I'm here online, so I can learn. I want to be criticized, and I want to know why I'm wrong about my thesis and my thinking, and why this is not a good purchase at 10% dividend. Let me know. Peace.